Yo, what's good, everybody? How's everybody doing? Hopefully, everybody's doing all right. Your boy is checking things out. Y'all, give me a second. Trying to get things straight. All right, y'all. So, big day in the market today. Um, Still under the weather a little bit, but we gonna get with it. Um, the S&P, the Dow, Nasdaq, Russell all went up today. It was kind of a crazy day when it comes to the stocks because you know, I think earlier the market was down earlier in the futures this morning. All of a sudden, the stocks went high. Of course, energy leading the way is energy. Oh, I forgot about. Gotta bring the mic a little closer so I don't fade out in and out, y'all. Anyways, but like I said, energy has been leading the way so far this year. Energy led the way last year. And I keep saying this, and I'm gonna say it again. Y'all see oil prices going up. Y'all see gas prices going up. I'm making money. You know what I mean? Unfortunately, I gotta pay the price of the pump too. But the residual effect is if you invest in certain energy stocks when they were, when they're at the bottom, you know what I mean? Right now, you just kind of smiling all the way to the bank right now. So, not everybody loves them high gas prices. I mean, I don't, but at least the residual effect is kind of nice. So, but as you can see, all the major indices was up today. So we gonna kind of make this down and dirty a little bit. We're gonna go over the ETF video on dividends. I did a video on dividends once before. We gonna revisit it again within the ETFs because it isn't very important that we understand dividend yield and dividend growth because there is a difference in the two. So depending on, like I said, if you're just investing in an ETF and whatever, none of this information matters to you because all you're going to do is just keep putting your money in there and it's just going to grow regardless. But one thing I will say, I did put this up on my Twitter. Where is it at? Let me look at my gallery real quick. All right. So far this year, right? When it comes to, I did put this video up on my socials earlier showing what we were going to talk about. But one specific thing I want to mention is last year, 2021, if you were going to put your money in savings, right? You ended up with 0% growth putting your money in savings. All right. We all know wages went up by 4%. Inflation was up by 7%. Real estate was up by 19%. The NASDAQ went up 21%. And the S&P 500 was up 27%. So if you invested in the NASDAQ or the S&P, your money was going to grow. As you can hear, 21%, 27%. Depending on what stocks you picked and whatnot, it could probably been more than that. You know what I mean? So, but it goes to show, and the reason why I'm talking about those numbers is because the fact that when you have your money just in savings, it's not doing anything. But if you had your money in the NASDAQ or the S&P, 21% and 27% respectively, you see what I'm saying? That's pretty good growth for a year. You know what I mean? So I just wanted to highlight that piece of information, and I actually got that off of because I was actually looking it up, and then when I was watching a YouTube video, the guy saying the same thing. I'm like, man, yes, you need. I will say this again, and I will keep saying it. Everybody needs emergency funds for if something's gonna happen. There is no if, ands, or buts about it. Everybody needs some type of emergency funds, but past that point, you're not getting anything by it because all the bank is going to do is lend out your own money, lend out your money to other people. That's all really what banks do. You know what I mean? You have all that money sitting in there and it's not really gaining anything. You see what I'm saying? Yo, what's going on, brother? I see you. But we going to talk about, next thing we going to talk about before we get into the real nitty is AT&T. They also talked about they're gonna cut their dividend in half, so from 52 cents to 20 to what is it? They're gonna cut it in half, so 21. So, but sorry, 26. So it's gonna go from 52 cents a share to 26 cents a share. So, which is a significant cut for, because a lot of people was in AT&T for the dividend, but now, I don't know, because they're gonna split. They're gonna take off that Warner Media. They're gonna have a communication side, and then they're gonna have a media side. So as you can see here, AT&T said on Tuesday it will spin off Warner Media in a $43 billion transaction to merge its media partners with Discovery Inc. and also cut its dividend by nearly half. AT&T shares will own 71% of the new Warner Brothers Discovery company and will receive 0.24 shares of Warner Brothers Discovery for each AT&T share owned. So, as you can see, chap lips, that sucks. All right, sorry about that. But yeah, so AT&T will have 7.2 billion in diluted shares outstanding after the transaction closes. Now, my thing is, when does this transaction start and when does it end? U.S. Telecom Groups will pay a dividend of $1.11 per share, down from $2.08 per share. This is the lower end 8 to 9 billion range that AT&T had focused earlier. AT&T shares fell nearly 5% at open. Yada yada yada. AT&T anticipates spending about $20 billion in capex this year to invest more heavily into fiber to the home broadband internet services span its 5G footprint. Yeah. AT&T expects debt ratio 2.5 2023. I'm trying to see when this is gonna start, because that's the one thing I haven't seen yet, when it's going to start. But the combination is expected to close in the second quarter. Okay, we'll be coming. Okay. We'll be playing catch up. Okay, so as you can see, AT&T is gonna split from the communications and the media sector. So I know there's some people that feel a type of way about this split because, you know, AT&T's been kind of on the bottom end of the barrel when it comes to T-Mobile, Verizon, when it comes to stocks. But T-Mobile doesn't give a dividend. Verizon, AT&T, and Vodafone gives dividends. And me personally, y'all know me, I love my dividends. You know what I mean? I love getting a little piece of that residual every time I invest in a company, especially a good company. Now, there can be a case made for AT&T, if they're a good company or not. But in the United States, there's 3 major carriers: T-Mobile, Verizon, AT&T. All that other little stuff don't even matter. So depending on how AT&T does this, will it help them? I guess we'll see further down the line, because Verizon literally got out of the media business not too long ago, and they wanted to strictly focus on communications. So when AT&T decided to go back into media, I was like, okay. So excuse me. But yeah, I mean, we can go through all the numbers, but if you ask me, when AT&T was $22 a share, I think it was, it's a good pickup. If AT&T hits $20 a share, I'm picking up more shares. Now, mind you, I had AT&T when it was damn near $29 a share, and I had 100 shares. I sold out of AT&T and bought more Verizon shares, and now I'm getting back into AT&T for a lower price, so I can buy more shares. So at that time, though, I made a little cheese. So, you know, of course, I cashed out the cheese to do a little bit better, to add to more of my Verizon stock. So I don't fine. You see what I'm saying? So, what the heck is going on? Yes, Steven, I see you there on the YouTube side. Yeah, you lost at least 3% if you kept your deal in savings. I mean, I like to buy on the dips, but there's just certain companies that I'm buying on the dips there, Steven, on the YouTube side. So, like me personally, there are only particular companies that I am looking out for, you know? So, but this is going to have me lead into, let's look at this is the big one right here, Google. I put this out the moment that I saw it come across my timeline. Google is about to do a 20-for-1 split. Now, for some of y'all that don't understand, Google, they have the so-called FANG stocks, and Google is one of them. So, my opinion, if they do that 20-for-1 stock split, I'm gonna get me some shares of Google. Why? Google is just too massive. And I was shocked when they said that they approved of them doing this, because now it's going to allow more people to invest in Google, which is a good idea, because that's why you had Tesla split. When Tesla did their split and then Apple did their split, literally like, I think it was a couple weeks apart, a couple months apart. But Apple did their split, Tesla did their split, and look what happened. Tesla went straight from, what is it? By the time they split, they were at 300 and something per share. Now they're all the way back up to $900 and something dollars per share, something like that. You know? So, but when, and I said this before, when Apple split, Apple was dropping at one point, Apple was at $119 a share. And I was trying to tell people, get into Apple. Now, Microsoft was at $130 something dollars a share when Apple did their split. It was, and I always say this all the time. If you're not a person that's picking stocks, then none of this what I'm talking and none of this that I'm saying is irrelevant. It's all irrelevant. You know, but if you're into picking your own stocks, obviously, me personally, the stocks that I'm picking to build up my own so-called dividend ETF. You see what I'm saying? And I'm literally picking the same companies that are in the majority of hedge funds and everybody else's ETF folder. You know what I'm saying? And I'm not shying away from, you know, these same type of gains. Hence why earlier in the earlier broadcasts, and if y'all go back and look, y'all know I talked about this a long time ago when I started this. You see what I'm saying? So Google is definitely a good growth stock. I guess they're giving a special dividend for those who already own the Google stock. So they're going to, I didn't see how much the special dividend was. So, but this is going to be nice. And I'm just looking at it now. Let's see. Before the Alphabet rebrand in 2015, Google effectively split its stock with the introduction of a third class of shares. Alphabet stock has doubled in the last 2 years, and a new split would make it more affordable. I would agree. I would agree. Because even if they split, I think if they split and their shares are around 150, 160, I think that thing can easily shoot back up to 200, 300 in a heartbeat within, you know, what, a year at least? Maybe 2? You know, because Google is everywhere, man. When it comes to ads, I mean, it's everything you do is Google. You know what I mean? Oh, double down. I mean, yeah. It seems like the political climate has the inside hand when it comes to stocks. Hence why they're trying to put laws in place to stop that madness. But I will definitely say, all right, let's go down. All right, here we go. Alphabet intends to split Class A, B, and C shares of the stock. The change requires shareholders' approval. Each shareholder at the close of business on July 1st will receive on July 15th and 19th additional shares for each share of the same class of the stock they own. Okay, so 2012 Class C with no voting rights. The company had a Class A shares which carry 1 vote per share. Class B shares, which are held closely by founders and early investors, carry 10 votes. Okay. Let's keep going. All right, shares of Alphabet stock have become more expensive lately at over $2,750 each. Yeah. And at the time of the market closing have doubled in price since May 2020. The lower the price could mean investors might be able to afford buying entire rather than fractional shares in the advertising company. Were the split to happen as of Tuesday's close, the cost of each share would go from $2,000 to $128.64, and each existing holder would get 19 shares for everyone. See, now that's what I'm talking about. I think Google is definitely going to be in my portfolio, even though they don't give a dividend. It's too sweet at 100 below 150. Man, look, you know what I mean. So at below 150, that stock is a definite plus to have. In y'all give me a second. That stock is definitely a must have in the portfolio, especially at this price, because now, regardless, even if they do a buyback years down the road, who cares? If you got in at this price, if Google runs back up to over $1,000 a share off this split, and I see it happening too. I mean, if y'all look at Google's advertising engine, it is ridiculous. It is everywhere. You see what I'm saying? So it's, I mean, this is a great opportunity for those, if you're looking to pick your own stocks, definitely, if you can pick up some shares of Google, now is the time, whenever it does happen anyway, because I will be picking up some myself. But let's go to what we are really here to see. Them talk about the ETF, dividends in the ETF. I want you guys to listen up. All right, here we go.
With big hikes from companies like Halliburton, Lennar, and Wells Fargo. What's going on with dividends right now? I know you emphasized there's been inflows for many years.
Yeah, I might have to turn y'all end up in order to hear it.
It's a topic right now.
Rightly so, but I think the key distinction here, and Todd and I have talked about this for a long, long time, is the distinction between the high yielders and the dividend growers.
Now, that is important when he talked about the dividend high yielders and the dividend growers. Now, as an example, what he's talking about, right? Let's when he's talking about high yield, let's find a stock that's like high yield. Okay, I know which one. Let's go Sunoco, which I used to own. So I used to own Sunoco. Ooh, and they're rocketing too, right? What he's talking about, right, is this. Now, I sold out of Sunoco at $42 a share, right? Because I was too top heavy in energy. And Sunoco was like 80 something cents a share. But what they're talking about, like the high yield, right, is 7.35. Let me roll that down if y'all can't see it. But the forward dividend is $3.30, which they pay quarterly. Not they don't pay $3.30. They pay annually, but quarterly I think it's like 80 something cents. But their dividend yield is like 7.35, as you can see there. Now the thing is, they talk about you don't want to have when you're investing in a company, you want the yield to be around 5% or less. You know what I mean? Of course, with energy companies, it's a little different. They have to pay a portion of their deal to stakeholders, investors. So, you know what I'm saying? So yeah, definitely, Steven. I wouldn't say hoarding, but definitely holding some cash for when those interest rates go up. But there's a rule that says, well, not a rule, but rule of thumb. They always say if try to keep your dividend yield around 5% or less. You know what I mean? So with that being said, this is what, and I'll let these guys talk about it because so I don't fumble anything.
Can see some outsized increases in high yields from some of the more cyclical players, but really the key is consistent growth of dividends. That tells you that you've got staying power in a name, and you've got that important ability to grow those dividends through a cycle.
Now, the pictures that you guys saw earlier that I sent before the stream was shots of this. Now, what he's talking about, this is what you have: dividend kings and dividend aristocrats. That's what he's talking about. Companies that steadily increase their dividends over a period of time. Not increase their dividend yield, but increase their dividend payout. Because then you know the company can afford to do that, a solid company. Usually when a company goes to cut its dividend, I mean, people are all sorts of upset, hence the whole AT&T and what they're doing. You know what I'm saying? But the fact that if a company can grow its dividend every year for that long and keep doing it, that's a sign of a strong company. So that's why you have some of these dividend aristocrats like 3M, I believe IBM is one, AbbVie is one, Chevron is one. So, and it's funny because I have all of those in my portfolio. So my portfolio literally mimics a lot of what these companies already have in their ETFs. You see what I'm saying? The only companies I really don't have heavy tech wise that I would like to have, I don't have Apple, I don't have Microsoft. And if whenever Google does their 21 split, I will be adding Google because Google is actually cheaper on the split than Apple and Microsoft, but the growth is still going to be insane over time. So, but Google does not give a dividend. They're giving a special dividend on the split, but you know what I'm saying? They're not, Google doesn't really pay a dividend over time. So, but like I said, there are a lot of dividend aristocrats out there, and it's one of the things that they're talking about is the consistent payout or the consistent increase of their dividends. Shoot, Chevron just did an increase in their dividend because of the amount of money they made from these past couple years, this past year. Yeah. So because with oil almost hitting $90 a barrel here, I think it settled at 88 something dollars a barrel. A lot of those companies aren't really drilling like that. I know a lot of people are screaming at the pump because the pump is high, but remind you, just in 2020, these companies couldn't do nothing because nobody was going anywhere, you know. And even though nobody was going anywhere, oil, gas was still at $2 and something change. You see what I'm saying? So, I mean, don't expect these companies to pump like that anytime soon. I'm gonna tell you that too. Because a lot of people think if these oil companies making that much money, they're going to turn around and pump out a whole lot of oil. Nope. They'll be, if anything, they're going to keep skimming the surface until they have to. So.
Extra important in an inflationary environment, absolutely. But consistency perhaps is more important than an unusually large hike that you haven't seen before from some of the more cyclical names.
No, I think that's a very good point. I mean, to me, when we talk.
And yes, and I'm reading on Steven on the YouTube side. Yes, VTI is great. A homeboy of mine, we were just talking about some ETFs last week when I was talking about VOO and SPY, and he was talking about VTI. They're all good ETFs. You see what I'm saying? Hence why I always say, for those who are just looking to invest, those names, the VTI, the VO, and SPR is good to go. Now, if you're looking to pick individual stocks, you can follow everybody else. Look at the top 2, top 3 stocks in their sectors right there. You know what I mean? Look at the balance sheet right there. Me personally, like I said, I'm building my dividend portfolio mostly first because I don't want to, I always say the difference between certain companies that have the difference between companies that have dividends and the companies that don't is I have to sell my shares when it comes to if I want to make money off these companies that don't have dividends, where when it comes to dividends, I'm going to consistently get some type of cash flow. So I could always use that cash flow to get into these growth companies that don't give me dividends. And that's what I'm looking to do. So the more I build up my own personal dividend ETF, my own personal dividend portfolio, I can take that money now and go buy these stocks that don't have dividends, these other growth stocks like, you know, like I said, like Google is one of them. Amazon, after seeing this, I would not be surprised if Amazon does the same thing maybe in a couple years. It's possible because now that Google done approved their 20-to-1 split, Amazon can do the same and allow people to actually get into Amazon more. And if that does happen, that means that would be great for investors that don't have to pay $2,000 or so to get into the stock, because Amazon and Google are going to continue to go fly off the roof anyway, regardless. And like I said, if you can get in for 150 on Google and Amazon, if Amazon ever does something like what Google is just doing right now, then I mean, it's a win-win. You see what I'm saying? So then those are stocks you can keep because you know they're just going to keep going up.
Talk about why are dividends a big topic right now. The key point is that when returns on the S&P 500 are expected to be much lower, perhaps, you know, in the mid, you know, single digits, for example.
All right, so what he's talking about, right? Because there's so much return in 2021, like remember I told you the Nasdaq returned 21%, the S&P did 27%. Now with interest rates raising, they might raise interest rates maybe 4 or 5 times this year, something like that. So if they raise interest rates, right, that means you're not going to have as much of a return, because now what's going to happen is the companies that have solid cash flow, that have actual, you know, profits, those are the ones that are going to stand out versus the companies that are just working off, what's the word that I'm looking for? I should say like some of these like IPOs that have no kind of cash flow, no kind of profits right now. Like those type of companies are gonna get hit by when the interest rates go up. You see what I'm saying? And plus, a lot of with the feds flooding the market with liquidity, you know, a lot of the stuff in the market right now is pretty high. So it's going to be harder to find bargains if you're looking to find a particular stock. You know what I mean? So, you know, one thing in the Intelligent Investor, the book that I've read, I haven't read it all yet. I still got it like 3/4 of the way done. But, you know, the book teaches, well, I won't say teaches, but when you read the book, you know, it states you don't want to buy stocks at a premium. You always want to try to catch stocks on the dip or on a correction. So, you know we've seen this, you know, 5-10% correction. It's a good time to get into the stock that you particularly want if your stock is dropping that far back. So, you know, and I always look at the charts. Like if you read the charts and see how, if a stock is all the way up here, you know what I mean? If his stock is like up here, I'm not buying up here. I'm going to wait until it scales back some. Now, some stocks might not scale too far back, but, you know, if you dollar cost average in, it won't be too bad. And I always talk about that. You always hear about that all the time. You dollar cost average in, you know, you buy, you take a nibble here, nibble there. when the stock drops, because like I said, a lot of these stocks are pretty expensive and some of them are pretty some of them are pretty high after 2021, you know what I mean? So
example, a 2 or 3% dividend return becomes much more important to your overall total return, no?
That's absolutely true, but also because the dividends in the S&P 500 aristocrats, Nobles, the ETF, because they grow faster than the dividends in the S&P 500, you very quickly, in the course of just a couple of years, get a little bit of cake and eat it too. What do I mean by that? The yield on that original investment compounds much more quickly, such that you really are having not just that small benefit in the initial higher yield, which now is a little higher than usual, about 100 basis points higher, but that delta compounds to 2, 3, 4, 500 basis points of more yield on cost versus owning just the S&P 500. And that's where it becomes a really key part of that.
you know what's so funny about what he's talking about, right? Like, let's say if you invest in the whole market, the whole S&P, or the Nasdaq or the Dow, whichever. But we always know you invest in the S&P because they have more companies, right? So if you, let's say, have an ETF for the S&P, got it. Let's say if you take some of those top companies in the S&P and you invest in those separately, they're already in S&P. They're already, like I talked about earlier, they're already in the top 1, 2, or 3 in their category, right? That's almost like double dipping. Not to mention the compound interest, not just you'll be getting from the ETF, but you turn around and you're getting the same compound interest off those companies individually is insane. Because what he's saying is that those companies can grow faster when it comes to dividend growth versus an ETF. So if you look at it, you know, yes, you can invest in an ETF, like I said, the VOOSPY VTI. But let's say if you took out the companies and invest in them individually, let's say if you take out a Chevron, let's say if you take out an Apple, let's say if you take out Microsoft and you individually invest in those as well on the side, you double dip. You already know they're in there, but you want to do it to let me say this. Disclaimer, you want to make sure you do it to blue chip companies that you know that are going to be around. You know what I mean? So because you know that the majority of the stock market has Apple, Microsoft, Facebook, Meta, you know, Amazon, Google. You see what I'm saying? So those main stocks are very heavy in all the indices. You see what I'm saying? So if you go and you take those particular stocks out, you know what I mean? As well as, like I said, maybe the top 1 or 2 in the sector, in each sector, it's literally double dipping. You know what I mean? So not only will you have one end growing a little faster, but you'll still have a steady growth on the other side too. Now, obviously, that takes a good amount of money to be doing that. But just for the sake of simplicity, that's what kind of how I see it and what he's talking about when you get to kind of double dip. You see what I'm saying? So
Longer term total return picture.
Yeah. Now, Todd, Simeon touched on this, but not all dividend funds are alike. The returns can be different here. Most of the dividend ETFs had returns in the mid 20% last year, maybe a tad below the S&P's 27% return. Those are ones, and I'm excluding high yield. How do you actually make a choice here? Is it as simple as Simeon was saying, or how do you make this decision? Here's some of the returns that we've seen recently.
So I think
hold on, y'all. I'm not seeing the chat real quick. Yo, what's going on, Smiley? Hey. AABB? No, I haven't heard of that, Miss Smiley. I'll look it up, though. We can look it up. Sorry, y'all. Let me get in this chat real quick. All right, here we go.
is that you focus on either dividend growth, companies that have consistently raised their dividends and are likely to do so in the future.
Here we go.
And companies that are ETFs that are constructed based on dividend yield. If you want growth, then you want to look into how far back into history are you looking for that dividend growth? So NOBL, which is a ProShares product, goes back 25 years. The Spider S&P dividend goes back 20 years. You've got Vanguard's VIG and the iShares Core dividend growth that are shorter than that period of time. And those two ETFs, VIG and DGRO, include companies like Apple.
Oh, my bad. I'm sitting here on mute. Anyway, no, that was me. I was on mute. Oh, life of a streamer, right? Anyway, like I was saying earlier, these companies aren't doing anything new. You see what I'm saying? Let me go back and reissue what I was saying. But these guys aren't doing anything new. Sorry, I had to restart my deal. But yeah, none of these financial institutions are doing anything different. They are all rinse and repeating the same pattern that has been successful. You go, you check the sectors, you take some of the top names out of those sectors that have been good for long periods of time. You stick them in an ETF, you stick it with a fee, and then you ask the person what they want, yada, yada, yada. And then you fit that person to that particular ETF and you say, here you go. This is and that. You pay us this. Boom. There it is. That's it. There is really nothing, special. Like I said, the only difference is like if you have an active investor, like they do have to make a certain amount of returns because you are paying for it. It is your retirement and you have to get back a certain amount. You see what I mean? So with that being said, they have to actively probably move this around, move that around, do this, do that, or whatever. So you kind of get a specific return or whatever you're looking for. But when it comes to just, let's say if you're investing in a dividend ETF, or you're looking to invest in an ETF itself, like I said before, investing in the market, the VOO, SPY, VTI, they're all good. But you could always look at each one of those ETFs, look at the specific companies that are in those ETFs, especially the ones that each of them have. And a lot of them have the same companies in there. And if you were to take those companies out and invest in those separately, that is double dipping, like I was saying earlier. But a lot of these guys, when they talk about, like, if you look into some of their ETFs that this guy's about to talk about, it's all the same. It is literally all the same. It just all depends on what fits you, what financial institution you go to, because you're about to hear him talk about all the same companies everybody talks about every day, every minute of the day when it comes to investing. You see what I'm saying?
Apple and Microsoft that have grown the dividend for 7 to 10 years plus, but that have not hit the 20 to 25-year mark. And so you don't have technology exposure the way you would in NOBL. You have much more exposure to consumer staples and financials and industrial companies. So you really need to understand whether you're looking for growth or you're looking at yield before you go a step further.
Right. So even this is very sophisticated, Todd. Even amongst aristocrats, there's a difference between those who are growing from 10 years and those who are growing them 25 years. It seems, though, overall, I'm trying to get.
Now, what he's talking about growing is just the output, meaning, like, let's say when the dividend is like 38 cents a share, then the company did 39 cents the following year, and then the next year did 40 cents the following year. That's how it ends up being a dividend king or a dividend aristocrat. Every year, even if it's a penny, it counts as increasing. You see what I'm saying?
Some guidance to the viewers here. The most important thing is to distinguish between those who are increasing their dividends regularly, whether it's 10 or 25 years, and those who just pay a high dividend. Is there evidence that one outperforms the other long term?
Well, the recent history has been favorable towards the dividend growth-oriented ETFs. So let's use the two Vanguard ETFs that are dividend ETFs that are popular. VIG, which is Vanguard Dividend Appreciation ETF, and VYM, which is Vanguard High Dividend Yield ETF. VIG has outperformed in the last 3 years by over 300 basis points by favoring those more growth-oriented sectors, including technology, as opposed to the above-average yields that you'd find within VYM.
All right, now you see what he has, right? He's talking about, you have Vanguard. Now, this is the same one that has VOO. And you guys are talking about VTI. All right, you guys are talking about Vanguard, right? If you go and look into these folders, I will put money on it. 90, not even that, 100% of the time, a lot of them have the same companies in their folders. Now, the disparity comes, it's when you have a high yield versus just the dividend itself. Because like I showed you earlier with Sunoco, it's 7.35. That's a high yield. You see what I'm saying? Now, when you're looking at high dividend, you could be looking at a company like Chevron that does $1.47 a share, or Home Depot, I think, that does $2 and something a share. You know, something like that. But that's what you have to look at when you're looking at these folders and these ETFs. Do not be fooled. Be very close watching of the companies that are in there. Like I said, if you're just doing a spread of the market, there's nothing wrong with that. But if you're looking to get a little ice cream on top of your cake, just look at the same companies that your folder has and just invest in the same companies on the side. That's it. Nothing special. A lot of people are paying for information that is just straight basic. All you got to do is look it up yourself. Now, as I said before, if you are not into doing the research yourself, I will keep saying this, and you just want to invest and just invest and set it and forget it, yes, invest in an ETF folder, go about your business. 20 years later, boom, you good. 20, 30 years later, you still gonna make good money. You know what I'm saying? But if you're trying to get into more detail, you're trying to flex a little bit, then you can have an ETF and still the companies out of those ETFs. Just make sure that that you're picking the right companies, and like I said, you can't go wrong with what they are doing, because there is no special formula. There is nothing special about it. They're just rinse, repeat, recycle. That is it when it comes to those stocks. Let me get into the chat real quick on Twitch. All right, I don't want to miss nothing. You see what I'm saying? So, but yes, definitely, you know, there is nothing special about what they're doing. So let's go back to see what he says.
VYM. So if you looking at the recent past, again, not guidance or not gospel, you can see that VIG was the stronger performer. We happen at CFRA to happen to like VIG more going forward because we think the cyclical slant is going to be rewarding to investors.
Now, Simeon, I know you've said several times in the past that there are fairly consistent inflows into Noble. Do you?
What, we just gonna kind of leave it there, because that's pretty much all about right there was he's talking about the different companies and all that. But what I wanted to let y'all know was the significance between the yield and the growth and what companies are doing in the long run, because it's very important y'all understand the fact that with the interest rates going up, dividends is going to be very important. It is cash flow. It is easy cash flow as long as you keep investing on that foundation, that dividend foundation. So, well, that's it for me. That's all I kind of wanted to point out there today. I still got this cough. I still sound like crap. But I definitely wanted to get that news out there today. So hopefully everybody be safe. You know what I mean? Y'all have a good week. Your boy's off for the rest of the week. So you know what I'm going to do right now? I'm going to wash dishes, and then I'm going to get some herbal tea, because yeah, it's rough. But yeah, y'all take it easy till next time. Y'all be safe.